Hey guys, welcome back to the channel. Today's video is about the housing bubble in Canada. We have been talking about this for a long time. There are numerous videos on this. This video actually took me 2 weeks to create, not just because there was a lot of research that was involved, there are a lot of numbers in this video, but also because I was not happy with the structure of the presentation because it just got too complicated because I just used too many economic terms which were getting complicated to understand. So I had to just taper down the tone, make it more simplified. And now I think I have a presentation which is a little bit controversial, but I think it talks about numbers and numbers don't lie. So let's get started. So in today's presentation, we'll be talking about Canada's housing bubble and we'll talk about the numbers there. Then we'll also talk about will the bubble burst in 2023 and 2024. There have been a lot of assumptions and a lot of things that people have been talking about. Some people have been very pro real estate and saying that the bubble will never pop, and others have been very bearish to an extent that some people have actually said that the market will crash more than 50% next year. And then we'll also talk about the dangerous assumptions that we are taking, whether we are talking pro-real estate or anti-real estate. There are some assumptions that might just turn out to be very wrong because 2023 recession will be a little bit different from the recessions that we have seen in the past. And finally, we'll talk about who will win in 2023 and 2024 and how I am preparing myself for the big recession. So let's talk about the bubble. We all saw this article said that Toronto is now the biggest real estate bubble in the world. Vancouver is at number 6. But the problem is a lot of people actually misread this as Canada. This is not Canada. This is just Toronto and Vancouver, the cities Toronto and Vancouver. And to be honest, we are in a bubble and we'll talk about this as we go along. And to understand this a little bit better, we first need to understand what supply and demand does to bubbles. Let's talk about supply and demand. Now, markets actually grow when demand outpaces supply. Now, we have seen that in the residential market, the demand has outpaced supply consistently in Canada. There was a small dip in 2008. There was another small dip when you see in 2017, 2018. But in general, real estate has been going up since 2005 and even before that. And now we are actually seeing a little bit decline that you see in the last 6 months. There's this decline. It's massive for 6 months. It might seem as a bubble popping. Now, when do you call high demand versus supply a bubble? A bubble is formed when the high demand is actually artificial, or the supply gap or the shortage in supply or the shortage in the housing market actually artificial. How does a demand become artificial? It either is like the 2008 crisis when there was ninja loans. Ninja loans are basically no income, no jobs, approved loans where people did not have jobs, people did not have income, people were not able to afford the houses, but they were still getting loans at as little as 0% down. Then we also saw in 2020 and 2022 when the interest rates were so low that people thought that they actually afford a lot more than they can actually afford if the interest rates were normal, and therefore there was artificial demand being created in the market. I'm not saying it was wrong. I'm not saying people took the wrong decisions. It's just that there was a little bit of artificial number that created and may have given an illusion of a bubble. Then the third point that creates artificial demand is fraud. And I talked about this in the last video that we created. Now, we don't know to what extent fraud is happening, but yes, it could create artificial demand because then people are actually faking their income and applying for houses or buying houses that they cannot afford, and that can create an artificial demand despite the affordability being very low. And then finally, it's estimated that on the supply side there are some houses actually empty, but government is actually taking measures to implement taxes if the house is actually vacant. Now, these 4 reasons are amongst many reasons why bubbles are created. Now, let's get one thing out of the way. I do agree that the Canadian market is in a bubble. But the problem with the Canadian bubble is, and if we compare the numbers from 2010 and 2022, you'll realize why this bubble keeps getting bigger and it's not popping. Now let's talk about population first. So in 2010, the population was 34 million. It has increased by about 15% in the last 12 years and it's closing in on 39 million now. That's a 15% increase. Now let's talk about number of dwellings. That basically means the number of houses where people can actually live. There were 13.3 million houses back in 2010. It has increased by 10% to about 14.6 million. So the first problem is that the population has outpaced the number of houses being built. So if we divide 34 million by 13.3 million, that actually gives us the number of people that can live per dwelling in Canada. This is not the household size, that will come later, but these are the number of people that can actually live per household in Canada. Now, if you compare this to 2022, obviously, if you divide 39 million and 14.6, we'll get 2.67. This has actually increased. Why? Because the population has actually outpaced the number of dwellings in Canada. So we are now at 2.67 million. So the average household size in 2010 was 2.9, which is close to 3 people living per household. That basically means because this number is greater than 2.5, we actually had a surplus of housing. We only required 11.7 million houses and we had 13.3. What that means is there were 1.6 million more houses back in 2010, and therefore there was no supply and demand shortage. It was for the longest time a buyer's market. Fast forward to 2022, with all the immigration that has happened, with people actually not getting married, more single people coming, more students coming in, there's more immigration happening, more young people living, more nuclear families, less joint families in Canada. A lot has changed in the last 12 years, and that has actually resulted in the average household size being reduced to 2.4. And that is a massive problem, because now what this means is this number is really not very balanced. We actually need 2.67 people to live per dwelling because we only have limited number of houses, but there are only 2.4 people living per dwelling because the household sizes have reduced. And this basically means that we actually need now 16.3 million houses just to satisfy the demand that we already have. And this is why we have a 1.7 million houses short in Canada as of today. Now let's talk about some of the other developed countries. We talk about most of the G7 countries and Australia and New Zealand, and we'll see that the gap is not massive. In fact, the household size is much bigger than the number of people that can actually live in a dwelling, because the number of dwellings have actually grown, or the population has not outpaced the number of houses that were being built. We see that in United States, we see that in France, Germany, Italy, Australia, and the two other bubbles that a lot of people actually talk about is UK and New Zealand. And that can also be seen in the price to income ratio. Now, price to income ratio is basically the home price that you are buying. So the median home price in Canada divided by the median household income. And that basically means that if the median household income is, let's say, $100,000, it's a lot less than that, but let's say for numbers, $100,000, the house price, the average house price in Canada is about $850,000. So $850,000 divided by $100,000, that gives us 8.5, and that's very expensive. Now this is whole of Canada. If you look at Toronto, it will be more than 11, 12. If you look at some of the other markets like Vancouver, it will be a lot higher. But if you look at Halifax, Calgary, some of the other suburbs like Kitchener, you could actually see that this is not as high as 8.5, and affordability is still there. If you look at other countries where there's no gap, where the household sizes are actually pretty equivalent to the number of people per dwelling, we actually see the numbers to be a lot lower. Now that we know that we have a supply shortage in Canada, the question is, can the bubble get any bigger? Now, these are the number of immigrants that have come in the last, I think 2000 to 2021. And we have seen that there were about 200 to 250,000 immigrants that were coming every year. And now the numbers actually shot up to 500,000 immigrants. And recently there was an announcement that in 2023 all the way to 2025, there will be 500,000, almost 500,000 immigrants that will be coming every single year. So what we are seeing is in the next 3 years, there'll be 1.5 million people who will be needing 625,000 houses. And this is on top of the 1.7 million shortage that we already have. So the shortage is only going to get worse as we go into 2025. Now, these numbers are crazy, but it gets crazier. Now, there have been several reports that Canada actually wants, and the Canadian government actually wants to build 400,000 homes per year, but they were only able to build 286,000 homes this year. And that's not built houses. That actually includes the houses that have just started construction, and the possession will be in the next 3 years. Now, CMHC also said that by 2030, we will need approximately 5.8 million more homes in order to meet the demand. On top of that, the problem is because of the recession, because of cost of labor, because of cost of goods, because of supply chain shortages. So there's a very high chance if the recession gets worse, there will be less houses built in 2023 and 2024, and the housing shortage will become worse, and there will be more people in the market looking for more houses, but not enough houses, and the supply shortage will be up to more than 2 million houses, and that would cause the prices to crash upwards again. Now, one of the other indicators of the housing shortage is rents. Now, if there are not enough buyers in the market, that means that there are more renters in the market. With more people coming in, what we have seen is that the rents have actually gone into double digits. They have increased by double digits. Despite the rent control in most markets in Canada, which is about 2.5 to 3%, because the houses are turning, the rents have actually gone up by about 11%. Now, this 11% is in fact lower. I've seen in Square One, one-bedroom condos go for $2,700, $2,800. And I'm sure people who are watching this, they will attest to it if you are in the market to rent right now. Now forget about Square One. I have my condo in downtown Kitchener. It's an excellent location on downtown Kitchener. My condo is a 1+1, 750 square feet, and it's rented for $2,050 plus utilities. So not just in Square One and city centers in downtown Toronto and Vancouver, even in Kitchener, which is a relatively smaller town, the rents are still very high. And one of the big reasons why the rents are high is because there were 450,000 more immigrants that actually landed in Canada. There were more than 100,000 students who actually landed in Canada. That's more than 500,000 people. And even if I count 3 people per household, there are upwards of 150,000 houses that were required for rent. Now, the other reason why the rents are actually shooting up is because there are more renters. Even people who were actually going to buy, they are not buying because they are fearful of the market. They are fearful of losing jobs. Even if they have money, they just want to have that buffer, and they are fearful of interest rates. And then we have the problem of reduced eligibility. The house prices have not gone down as much as the eligibility has, because now if you're earning $150,000, you can only borrow 4 times that salary. Earlier, it used to be 4.5 to 5 times. Now it's down to 4 times, and that is actually causing less people getting eligible, and they are all becoming renters. And that's one of the reasons why rents have actually shot up in the last few months. The problem is simple, and we discussed that in numbers, that we do not have enough houses in Canada. So if there are more buyers in the market that we saw during the pandemic, the houses keep going up. If we have more renters in the market, because the housing supply is the same, the rents keep going up. So are we in a bubble in Canada? Yes, we are. We cannot deny that. But we also cannot ignore the fact that we have 1.7 million houses that are short, and this is only going to get worse with increased inflation and with the recession actually not allowing the builders to build more houses. Now, the other thing that we keep hearing is the 2008 subprime crisis, and we compare what's happening today with the 2008 crisis, but it's not the same because it's not US and it's not 2008. Now, the biggest reason why we had the subprime crisis was there were ninja loans that were given by over 1,000 lenders in the US. Ninja loans are basically no income, no job approved. If you do not have any income, you do not have any job, you can't afford the house, we'll still give you a house without any equity in it. You actually pay 0% down or very little down, and you'll get the house. And when the interest rate actually went up, these houses went into foreclosure, and that was a really big reason. That's not the problem that we have in Canada right now. And to be honest, it was not a really big problem back then as well, because we have a highly regulated banking environment here. There are top 6 banks in Canada that actually make 67% of all mortgages, and they all qualify with a stress test. Now, back in the pandemic, when the interest rates were about 1.5, 2%, some people actually got it at 1% variable, you still had to qualify at 5.25% interest rate, and only then will you get a house. I can talk about stress test in a little bit detail, but that's a topic for another day. The other problem was that it's estimated that 20% of the mortgages in the US back in 2006, 2007 were in fact subprime. Subprime basically means that they were not the top banks, they were not qualifying with the stress test, they were just getting mortgages even if they do not have enough salary to support those mortgages. And it's estimated that just right before the crash in 2008, there were over 50% of mortgages that were ninja loans, and that particular number is unsustainable. Compared to what we are seeing in Canada, this number right now is 7 to 12%, and only 1% of those mortgages are private loans. Now, when we talk about subprime mortgages in Canada, it doesn't mean ninja loans. All it means is that they did not qualify with the top 6-7 banks, and they had to go with a B lender, where the rules are a little bit less stringent, but still you need to have some amount of income to qualify for the house, and the rules are much stricter than not having any income and even then qualifying for a house. So even the definition of subprime is very different in Canada this year versus what it was in the US back in 2008. And the third most important point is that even before the 2008 subprime crisis, the delinquency rate, which is the default rate, was as high as 4.5 to 5% in Canada. However, in Canada right now, the delinquency rate is as low as 0.14%, and this is an estimate of last month. And those are a few reasons why what's happening right now, or what's going to happen in 2023 and 24 because of the recession, will be very different from how the market reacted back in 2008, because the fundamentals were very different, and the reasons for those crashes, both the crashes, if we assume a crash in 2023, is very, very different. You must have heard this a million times: you can't lose money in real estate. The problem with this is this actually is incomplete. You can't lose money in real estate long term. So even if you bought the house in 2006, 2007 at the peak of the market, if you held the house till 2020, you actually made 100% return on that money. So even if you buy at the peak, like people bought in 2020 and 2021 and 22, even if you buy at that peak, and if you're able to hold till 2030, you can't lose in real estate, because long term, Real estate is a scarce resource because we can't build enough houses to keep up with population, and therefore long term, because of the supply and demand gap, your real estate will grow. Now, having said that, for real estate and other asset classes, 2023 will be a bit different. First of all, interest rates are at a record high. Affordability is at a record low because the inflation is high, everything is more expensive, people are actually paying more in mortgages, and therefore they do not have enough discretionary spending left to do fun stuff, to travel. Now, because people have less money, the problem is that they will not be spending on things that they usually would not require, and business owners will feel the pain for it. There'll be less people going to nail salons, there'll be less people going to hair salons to get their hair done, and all that actually leads businesses to then fire people, and that's where people will start losing jobs and we'll go into a deeper recession. And now what would happen is we have an economy where there are people who are out of a job, there are businesses who are out of business, and that would lead to people who actually leverage themselves too much and they had negative cash flow properties because they felt that the cash flow will always come from their business. They'll have to sell those houses to keep their businesses afloat, to keep their life afloat, and that will lead to higher inventory in the market, and then the demand will be a lot lower than the supply in the market, and therefore the housing market will stabilize, and there's a very high chance that we'll see a correction in the first half of 2023 till Bank of Canada decides to start cutting interest rate to stop the bleed. Now, the other thing that we'll see in 2023, and we are actually seeing that now, is stagflation. Now, by definition, stagflation in economics means recession inflation. It's a situation in which the inflation rate is high or increasing, the economic growth slows down, and unemployment remains steadily high. It presents a dilemma for economic policy since actions intended to lower inflation may increase unemployment. And that's what is happening right now. Because Bank of Canada is actually increasing interest rates, it just doesn't impact our mortgages. It also impacts business owners to raise more money because there's no cheap capital available. That's the reason why the stock market is actually going down. The tech companies are suffering the most because there's a lot of investment that comes, and these investments are actually getting more expensive. We've already seen a lot of tech companies actually fire a lot of people, and the efforts that are being made to reduce inflation and ease a little bit of pressure on the daily household is actually leading to more unemployment, and that is what stagflation is. And this time it's a lot different because in any other recession, the answer is to print more money so that they can stimulate the economy and increase the money supply. But the problem is that this recession actually came because of printing more money and because of inflation, which is very different from any other recession. So the government can actually not print more money, and if they do, they will actually devalue currency, and that would lead to high cost of imports, and that would again worsen the problem of inflation. And how much do we coerce Bank of Canada for what they are doing and increasing the interest rates? It's an impossible choice for Bank of Canada and the government to take us out of this. They had to print more money, but during the pandemic, because people were dying, they needed money, they were losing jobs, there was so much uncertainty, and they always knew this was coming. The only thing is that government actually did not give people enough heads up, and in fact Bank of Canada went on air and said that they'll not be increasing interest rates till 2023, but then life happens, economy happens, Russia and Ukraine happens, and then they had to increase the interest rates way ahead of the time and quickly to curb inflation. And that brings us to today, where the government has no choice but to lead us into a recession. I also wanted to talk about who will win in 2023 and how you and I can actually win in this particular market. The number one thing that we need to do is we need to be income ready to protect existing assets. If you're a homeowner, if you are a renter, if you own a car, if you have high interest debt, you need to first protect your interest before thinking of investing into assets. So the first thing that we do is you need to ensure that your job is secure. If you are new to Canada, you need to ensure that you are going into industries that are actually recession proof, like healthcare, education are recession proof. So you need to be able to understand which places to apply and which places to go for. I know it's very difficult to choose industries in a market where there are less jobs, but still you need to first realize and understand whether your job is secure or not. And it could be as easy as going up to the employer and asking, are we okay? The second thing that we need to protect is we need to pay our high interest debt. If you have a car at 8, 9, 10%, or if you have a student loan at 10 to 15%, you need to pay that first, so that if you lose your job and if there's a tough time that happens in 2023 and 2024, you're at least able to protect your family from going deeper into debt. And the third and the most important thing is that we need to have an emergency fund so that if we lose our jobs, we are just not losing our house, we are not losing our shelter, we just don't lose everything just because we lost our job. We need to make sure that our expenses are actually way lower. We need to do a budget. We need to understand what is it that we are actually spending more. Yes, that means that we are making sacrifices for the next 3 or 4 or 6 months or even a year, but that's okay because we need to protect our assets first. If you are a homeowner, especially, we need to make some sacrifices so that we ensure that we still have our house protected. And the last thing that we need to ensure is that we are upskilling and we are able to make a little bit more money next year so that we can weather any storm that comes and even thrive in this recession. And that brings me to the second thing that I am personally doing in order to win in 2023 and 2024, and that is to be cash ready to buy undervalued assets. And that could only happen if you have a side hustle, if you have additional cash, if you didn't overspend, if you are doing a budget, and if you have cash reserves to be able to invest into assets next year. The number one thing that we need to take care of if you're a first time homeowner, you're renting right now, is that it's a golden opportunity to buy a house. Yes, the interest rates will be very high, but you'll also get a house at a low price, and that will grow in value over time. Now, as a licensed mortgage agent, I actually get this question a lot. Is it the right time to buy? Should I wait till mid of 2023 when the market will bottom out? We just don't know. We can't time the market. And the answer to this is we need to buy when we can afford. We need to buy with a rule of 35. We need to buy what we will be able to sustain over long term. So I have actually made a rule of 35 calculator that you can download from the link in the description. Your overall house related expenses, which includes your property tax, your mortgage payments, your condo fee, your utility bill, should not exceed 35% of your net income after taxes, and that's household income. So if you are getting $10,000 into your household as a couple, you cannot spend more than $3,500 to $4,000 on house related expenses, and that would make sure that you are protected even if the market goes down or you lose your job. Now, if you're an investor like me, you already own your house, you are sitting on cash, I would just watch out the market, work with your mortgage agent, work with your realtor to make sure that you understand your numbers and you scoop real estate in great locations at a discount, because they will be available at a discount next year. The second most important thing for investors is we do not have to be emotional. We need to stick to numbers. We need to stick to cash flow. We should not be buying properties which are $1,000 cash flow negative, because that's not sustainable. We need to be able to scoop properties that actually make sense in numbers. It's an investment house. It needs to generate some money, or it at least needs to pay for all its expenses and a little bit of principal, and only then you buy. So make sure that you're booking a call with me and understanding how to analyze rental properties so that you don't make a mistake of overbuying and buying with emotion rather than numbers. And last but not the least, and that's probably the most important point here, is that we need to buy with an intention to keep for 20 years. We should not buy something that we'll just flip, because this is not a market to flip. This is in fact not a market to burr as well, because this is a market that's declining. We need to scoop something. We need to make sure the numbers make sense. We need to make sure that at least it pays for itself, and we keep for 20 years. And in 20 years, we refinance it. We just, build more wealth from this real estate, or we sell it and retire. This needs to be a long-term play. It cannot be done in days, months, and years anymore. So just to wrap up, are we in a bubble? The answer is yes. But the problem with the Canadian bubble is that it just doesn't pop because of the supply shortage that we have, because population far exceeds the supply of housing that we have in Canada. And therefore, yes, we might see and catch a break in 2023 when the real estate will actually correct itself. But that's the time to scoop a few investments so that long term, the real estate the portfolio actually grows to 3-4x by just keeping that in our portfolio, and we are able to retire. Unless there is a massive change in policy that comes to Canada, there's a very high chance that our kids and the future generation will not be able to buy houses, because they'll be so expensive that our incomes will not be able to justify buying houses. So we have the onus of building real estate and wealth for our future generation as well, because we are likely to have a generation of renters in the next 10 years. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए bye bye.